Hey YouTube, we're going to go through PayPal Holdings, ticker symbol PYPL. Year to date, company is down 26% over the course of 1 year, down 30%. And PayPal just reported their earnings yesterday, 2 days ago, actually, now 2 days ago, and beat on top and bottom lines. Analysts have revised their earnings, their expectations about 50-50, some up, some down. So still a few analysts here that are expecting lower growth and others that are expecting things to start turning back positive. Well, not positive, but to higher growth. So in the earnings call transcript, the new CEO, Alex Chris, was our first time being able to see and listen to him explain his future plan for the company. And mostly what he was talking about is like he took a step back. He looked back from the outside in and then walked through the business and figured out how things were moving. He listened to all the issues and complaints and then kind of compiled them all together and come up with a future plan for the company to grow and figure out where to innovate in and what to get rid of. Get rid of certain things, innovate over here and make the business more efficient, because one of his big takeaways that he got is they know that competition and complexity have increased and the company's focus has not been clear. So they are doing a lot of things, but we are not focused enough with their resource allocation. So that was one of the big lines that I got out of what he was saying, was that it kind of confirms that the company just doesn't seem to know where to go or what to do next. It's just kind of lost. And it looks like that is what he's going to focus on, is trying to find a plan and a direction for this company. And throughout more of his commentary, he gave another takeaway that I found that was pretty important. Their cost basis remains too high, and it is actually slowing them down. He's in the process of evaluating their most profitable growth priorities and aligning our resources to those priorities. And then they would become leaner, more efficient, and more effective, driving greater velocity, innovation, and impact for their customers. So again, he's just going to basically kind of hit the reset button in a good way. And all right, here's what we're going to be doing. This is the plan. This is the future innovation. Here's where we're going to focus our resources on. So aside from what Alex Chris is doing, they are in the process of buying back a good amount of shares. They have a massive buyback program that they announced of like $15 billion, and I think they've got $11 billion left in it. So in the third quarter, they completed an additional $1.4 billion in share repurchases through September 30th and now have returned $4.4 billion to shareholders. For the full year, so yeah, they got about $11.6 billion left there. For the full year, we continue to expect to allocate approximately $5 billion to our share repurchase program. So they're expecting to buy another $5 billion this next quarter. It's a pretty heavy buyback program. That'd be nice. Given our conviction in our business relative to its valuation today, we have taken a more aggressive approach to our capital return program and have reduced our weighted average shares outstanding by 7% over the last 8 quarters. So, I mean, that's good as a shareholder for sure to see such an aggressive buyback program, and they do have the capital and the resources to continue to do that and finish off that buyback program. And now is no better time, especially with how cheap the shares are, and they just stated that right here, given how cheap their valuation is today. So good to know that they think their valuation is even cheap as well. On their earnings report, we can see the last 3 releases they gave us. This is the average price paid per share. It was 71, 61, and then 61 again for shares, price paid per share. And we can see it over here. We got 11.4, almost $5 billion left in the share buyback program. So plenty of money to continue buying shares, and you almost use half of it this next quarter just buying back shares. So if that comes true and they actually do that, I think we might see a very large uptick stock price, because if they're buying back 5 billion shares and it's not getting reissued, that's gonna that definitely help out the stock price quite a bit. So over on the financials of PayPal, we've got our revenue, gross profit, net income. All three are still kind of trending higher. Net income slightly down compared to all-time highs, but it is within range of where it has been before. Revenue still growing. Gross profit is declining slightly. Gross margins, we can see 47% and just a steady decline, mostly because of competition entering the marketplace and they have to reduce their take rate. Net margins 13%. Revenue, gross profit, year-over-year change, really just no growth of the company. It just hit a brick wall after 2021 and that's it. It just hit a brick wall and hasn't found its way around yet. So hopefully Chris can find a way around the wall and they can start maintaining at least 10% growth going forward, 5-10%, depending on what they can come up with. Return on invested capital, 12%. PE ratio, 16.4, historically the cheapest it has ever been on PE. Not sure why that just did that. Earnings yield, 6.6%. And cash short-term debt. The company's got a lot of short-term debt and a lot of debt in total, but we'll look at the earnings release and see where some of that debt is. Because this is PayPal, they probably have some customer holdings on there, which we can cross off and actually show that we have less debt than what we show on here. Net income to free cash flow. We are producing more net income to free cash flow, which is good, but it is kind of declining, leveling off here overall. It's kind of the same trend as their subscriber count. Their subscriber count has declined in their most recent kind of last few quarters, really. I think they declined about 2 billion or 2 million subscribers. So right here we can see their total active accounts has peaked in Q4 of last year, but since has declined by about 7 million active accounts. Basically, we are now in line with like Q1, Q2 of last year. And then we can come up here, total payment volume. We got $387 billion in total payment volume. That is a new record for the company and has kind of just sort of slowly trended its way up to that point. So we got free cash flow, which is starting to trend lower a little bit, sitting at $3.4 billion. There was a little bit of a more, we'll see in the cash flows, there's a little bit of a reason for that. Share count dilution, they are aggressively buying back shares. It'd be nice to see them really step on the gas a little bit over there. Capital expenditures sitting at $660 million and just kind of flat. On the balance sheet, company's got $11.5 billion in cash. We kind of went over that. They've got, right here, we have funds receivable, customer accounts, and down here, same thing, funds payable, amounts due to customers. There's $4 billion difference. So we'll add 4 billion, we'll maintain $4 billion, the liability side of things. So we got $11.5 billion in cash. We've got $56.7 billion in total liabilities, minus out 34.6, which we just basically minus out that. That gives us leaves us with $20.1 billion in debt, still short on debt to cash basis. They have plenty of cash to cover their short-term liabilities because you subtract out $34 billion from $43.4 billion. That leaves you with roughly $7 billion there in short-term liabilities, which can easily be covered with the amount of cash they have. Also down here, retained earnings, they got $22 billion in retained earnings that they can use if they choose to. They can use it for their share buyback program. They can issue a dividend in the future if they want, but there's no mention of that. I doubt they will do that because they are likely probably to search for innovation, not just to pay out a dividend, find the easy route. So over on the cash flows, on the left-hand side is the most recent number. We did $2.8 billion in the last 9 months. Prior year, we're almost double that. We got depreciation, we get to add back in, we got stock-based compensation, that's still getting handed out over there. Here's where the change came in that reduced their cash flows so much is their origins of loans receivable. They must have had some loans that came due and they had to pay back those loans. So originally, probably proceeds of them was 3.7, but then they had to pay out 5.7. So, it cost them about $2 billion, which then reduced their CFOs by $2 billion, which then obviously doesn't look as good as it did last year, but it would have been right in line with last year's numbers on CFOs. And then you subtract out your CapEx, which is slightly down year over year. But what we ended up with here now is $1.7 billion free cash flow in the last 9 months. Still very positive cash flow company. Now we come over here to the comps. We have 4 other companies to compare to. Scroll down over here to PayPal. We currently have return on invested capital as our red flag that is slightly red here. Typically like to see it 15% or more. We got market cap, revenue. You can see where PayPal's sitting on the board here. Same thing with gross profit, revenue, and income. PayPal is the first and obviously the leader on the board. Growth rate, PayPal 40%. I don't see that happening. Maybe, I guess, on EPS since they're going to buy back so many shares. That's actually probably very likely. Revenue 10%. And the other companies here 34-16, 26-6, and 8-3. So PayPal definitely showing like it's got they're forecasting for some decent growth for the next 5 years. Gross margins sitting at 47%, not the best as they could be, but within line of the competition near the upper end. Operating margin sitting at 15.6, again, not the best. Profit margin 12.9, again, not quite the best. FI seems to have the best margins here on the board. Free cash flow of $3.4 billion, FI 3.8, return on invested capital 12%, PE ratio 15.4. Earnings yield, we've got 6.6%, and everybody else just kind of barely any kind of earnings yield really. Overall, against the competition, PayPal still looks to be the leader in my, what I'm seeing here on these basic numbers. It looks to me like PayPal to FI are the two that I would be most interested in a deeper comparison. Peer valuation of value of $49.11. Multiples comparison. So there we have two negative companies on the board. We can eliminate Square and FIS. Comparing to GPN and FI, we get a price comparable of $104.08 per share. Manual PE, we take our market cap minus cash, add in debt divided by cash from operations. We could really divide that out by 30, an additional 34 billion, which would then leave us with about 22 billion on there. 22 billion, you add that back into your market cap, divide that out, you're probably looking not overvalued, but closer to undervalued, in which we can just change that out real quick. We can just do 22, and that kind of tells you roughly that's what you're actually truly looking at, is about 17 years to earn your market cap. Price to book, 5-year average 7.7, currently sit at 305. Peg ratio 1.64, forward looking 1.05. So based on peg ratio, kind of pushing the undervalued, forward looking, and right now fairly valued. Graham's valuation gives them $100.84 per share. For DCF valuation, history of a growth rate on free cash flow is 22%. Analysts are predicting 8%. I'm just going to maintain that at 8% as well. That gives them a DCF of $85.83. Rule 72, we got three sources of an EPS growth rate for 13% for an average for the next 3 years. So that 13 then goes into 72, 5.5 times. That goes into 10 years, 1.8 times. So our future EPS then becomes 14. So 14 tells us that our fair value is going to be $90.43. PayPal currently trading at $55.06. Fair market value, $86. 30% margin safety, $60. Analyst price target of $80.31. Actually, when I did this, that was higher. That was about $5 or $6 higher. And since then, they have revised their expectations, and apparently are lowering their expectations on the company, and now have a new price target of $80 per share. So we have valued PayPal before on this channel, and last time we valued it, we got $94 fair value. Buy price, 30% margin safety is $65. And we can come over here and we can see where our changes were. So our peg was same, manual peg basically the same, years to valuation identical. Price to book is where things start to change a little bit. Lower price to book today. Obviously the price has dropped. Benjamin Graham valuation has dropped about 20%, or sorry, $20. DCF actually up slightly. Multiples valuation down slightly. Rule 72 down slightly, and PD Lynch fair value also down slightly. So the only one that revised up was actually our DCF. Everything else had gone slightly down, and a lot of these are based off of, expectations, percentages. So like the Benjamin Graham valuation is based on percentage. DCF is actually just based on free cash flow percentage, but different version of it, right? Multiples comparison, that's just comparing it to the competition. Where's the competition at? If the competition is higher, then it makes PayPal more undervalued. But if competition pulls back with PayPal, it makes PayPal more closer to fairly valued. So I'm assuming the competition has pulled back also on valuations. Rule 72, same thing. If the EPS comes in light, then Rule 72 drops, but it only drops slightly, so it's not a big deal there. P Lynch valuation, same thing. It's determines on growth, and if growth isn't there, then the P Lynch valuation tells us that it's not worth as much. So kind of gives you a little understanding that how expectations and how changes make quarter over quarter what it does to your valuation, which is why we have a 30% margin of safety. If you want access to this valuation spreadsheet, there will be a link in the description down below that you can go to see if this is something that is interesting to you, and you can pick it up over at patreon.com. So over here on the stock chart, we're on the daily chart, and it's just locked in a downtrend still. There's just There's no if, ands, or but about it. It's just in a downtrend. It broke through the channel, and because of earnings, it popped back into the channel. The only thing I really see is if we can make our way back up to the top of this channel, we're probably going to reject it, depending on how we get there. If we trend into it, we'll probably get rejected at it. Maybe pull back, retest this area, this trend line as well, and then maybe eventually we find ourselves breaking out. There's no reason right now that I see for people to just to pile into this stock and start pushing this thing through. The only thing I see right now that's got good momentum for us, if you're a shareholder, is their share buyback program. That's going to help push this stock back up, especially if they're going to buy back about $5 billion shares in the next quarter, which they looks like they forecasted for us. That might push this up to here, and then that might be the end of their buyback. Once that expires, we'll probably see a little bit of a sell-off because people are finally like, oh my God, I'm kind of in the green on it. I'm going to sell, or whatever, closer to green, and they're just going to sell it, right? A lot of people are looking at this chart, they're going to sell. They're probably looking at selling right here because they're like, well, I think this thing's just going to go to zero, which it can. So that's what I see is comes up to here, pulls back, and then maybe finally we find a bounce out of this channel and find our way back up to $80 to $90 per share someday in the future. But for now, all I see is just the price moving up to $65 per share. And that's we'll have to reassess where things are. I would assume that would probably take a quarter to get there. Maybe not. I mean, it's only $10 away. You can probably do it here pretty quickly. So we'll have to wait and see what happens with PayPal. But that's what I'm seeing is a bounce back up to the top of the channel, probably a rejection at the top of the channel, and then maybe a retest at the lower end of the channel, and then find its way out of the channel finally. But that is it for PayPal. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.